Imagine a kid on a playground selling lemonade for $1. Now imagine that kid convinces other kids to buy pieces of his lemonade stand for 50 cents each. Those kids don't make lemonade. They don't squeeze lemons. They just own a piece of the stand. And every day they argue about how much those pieces are worth. Sometimes they say 60 cents, sometimes 40 cents. Sometimes they lose their minds and say $5. Welcome to the stock market. It's a playground where adults trade pieces of lemonade stands. Except instead of lemonade, it's Apple, Tesla, McDonald's, and instead of kids, it's pension funds, billionaires, and some guy named Gary who just downloaded Robinhood. Here's the thing most people don't know. The stock market isn't some ancient financial ritual invented by suits in Manhattan. It started in 1602 with the Dutch East India Company. Back then, merchants needed money to send ships to Asia to grab spices. Nutmeg, cloves, the kind of stuff people would literally murder each other over in the 1600s. But ships were expensive and risky. Pirates, storms, scurvy. So the Dutch created a genius system. Instead of one merchant risking everything, they let hundreds of people each chip in a little money. In return, a piece of the profits. They called these pieces shares, and just like that, the stock market was born. Fast forward to today, and that same concept has turned into a $100 trillion global casino. The S&P 500, which is basically the 500 biggest companies in America, is worth about $45 trillion. That's more than the entire GDP of every country on Earth except the US and China. People aren't trading spices anymore. They're trading promises. So how does this playground actually work? Let's use Apple as an example. Apple has about 15.3 billion shares floating around. Each share, as of early 2025, costs around $230. That means Apple's total value, what finance nerds call market cap, is about $3.5 trillion. But here's the twist. Apple doesn't have $3.5 trillion sitting in a bank vault. That number is just what people agree the company is worth based on what they're willing to pay for shares. It's a popularity contest with money. And sometimes, the contest gets insane. In 2021, Tesla's stock was trading at a P/E ratio of 352. Translation? People were paying $352 for every $1 of profit Tesla made. That's like paying $352 for a burger that costs $1 to make, because you really believe in the burger's future. By comparison, the average P/E ratio for the S&P 500 historically hovers around 15 to 18 times earnings. But in 2021, nobody cared. The money printer was going brrr. Interest rates were at 0%. Everyone had stimulus checks burning holes in their pockets. Stocks went vertical, until they didn't. By 2022, the Nasdaq, home to all the tech darlings, crashed 33%. Billions evaporated. And that's the secret nobody tells. The stock market isn't just a place where companies are worth what they're worth. It's a place where they're worth whatever people feel like paying that day. So what does this mean for someone watching this right now? Here's the reality. As of February 2025, the stock market is sitting at all-time highs. The S&P 500 has returned an average of about 10% per year over the last century. That includes the Great Depression, World War II, the dot-com bubble, the 2008 financial crisis, COVID. But, and this is critical, that 10% average includes years where it dropped 37%, like 2008. And years where it climbed 28%, like 2021. It's not a smooth ride. It's a drunk Uber driver on a highway at 2 a.m. Right now, the Magnificent Seven stocks, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, make up about 30% of the entire S&P 500's value. That means if these 7 companies sneeze, the whole market catches pneumonia. And here's where it gets weird. Nvidia alone has added more market value in the last 2 years than the entire market cap of most countries. Is that normal? No. Is it sustainable? Maybe, maybe not. That's the game. The stock market is just organized chaos. It's millions of people making billions of bets on which lemonade stands will crush it and which will collapse. Sometimes they're right. Sometimes they're spectacularly wrong. But here's what history teaches us. Over the long run, the market rewards patience, not panic. It punishes people who think they're smarter than everyone else. And it doesn't care about your feelings. As Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. So, if someone asks what the stock market is, tell them this. It's a playground where people trade pieces of companies. Sometimes those pieces go up, sometimes they go down, and sometimes they go completely sideways for years. The trick isn't to predict which way they'll go. The trick is to not get wrecked when you're wrong. Because in this playground, the house always wins. Unless you're willing to stay on the swings long enough to see the chaos turn into compounding. Subscribe if you want more financial chaos explained simply.